For decades, the standard formula for global corporate expansion was simple: extract raw materials, manufacture goods, and maximize shareholder profit. That singular pursuit generated rapid, unchecked growth, but it eventually collided with reality. Decades of extraction degraded regional ecosystems, while the wealth gap between executing corporations and their host communities widened. The formal pushback against this model materialized in 1987. The United Nations World Commission on Environment and Development, led by Gro Harlem Brundtland, released a defining report called Our Common Future. The Brundtland Commission introduced the concept of intergenerational fairness. They defined sustainable development as meeting the needs of the present without compromising the ability of future generations to meet their own. In modern international business, that concept forms a strict baseline. A company must conduct its operations without inflicting detrimental effects on the surrounding community or the natural environment. Today, failing to meet that baseline invites crippling penalties and immediate consumer backlash. Embedding sustainability into corporate strategy now determines whether a multinational can maintain its legal license to operate and its access to global markets. The pressure to adapt is coming from all sides. A socially aware consumer base rewards ethical brands with their loyalty, while governments worldwide consistently enforce stricter environmental regulations. Inside the boardroom, the pressure is financial. The finance sector now heavily weights environmental, social, and governance, or ESG, criteria. Investors view a strong sustainability track record as evidence that a company can navigate supply chain disruptions and mitigate long-term risk. This infographic maps the triple bottom line framework. The first dimension, profit, forces leadership to prioritize long-term economic viability over short-term earnings. The second, people, measures responsibility to employees, customers, and communities. Finally, planet targets the environmental footprint, reducing emissions and resource consumption. When a corporation effectively balances these three dimensions, it protects its brand reputation and builds resilience against the increasing scarcity of natural resources. While the triple bottom line provides an internal compass, multinational operations require a unified external standard to coordinate action across borders. That standard was established in 2015. Alongside the Paris Agreement, 192 nations reached a unified commitment to address the global climate crisis. This animated breakdown maps the result: the United Nations Sustainable Development Goals. These are 17 discrete objectives supported by 5 core pillars: people, planet, peace, prosperity, and partnership. Multinational enterprises are positioned to hit these targets directly. Because they operate across borders, their daily decisions dictate international trade flows, global investment, and the large-scale transfer of new technologies. Aligning corporate strategy with these global goals creates tangible business value. It reduces the risk of non-compliance, secures a competitive market advantage, and opens access to capital through green finance and impact investing. Having a unified global blueprint is essential, but applying it across diverse, localized regulatory environments creates significant logistical friction. On the environmental side, international businesses must untangle complex operations. They are now tasked with tracking climate impacts across entire supply chains and managing the exhaustion of the water, forests, and minerals they rely on. The social challenges are equally difficult. A multinational firm must bridge infrastructure gaps between countries, guarantee fair labor practices at every tier of production, and maintain social equity in wildly different host nations. To manage this friction, companies deploy the circular economy model. This continuous loop minimizes waste, recycling resources back into the supply chain. Making this functional requires 2 operational pivots: transitioning to renewable energy and enforcing ethical sourcing mandates. These operational changes only succeed when they are transparent. By sharing environmental performance metrics with local stakeholders, a company builds the trust required to operate as a legitimate corporate citizen. By moving from shareholder primacy to stakeholder capitalism, companies align their survival with the well-being of their employees, customers, and the environment. In a landscape defined by climate risk, these sustainable business models offer a framework for building a more resilient global economy.